Lender's 20 questions on pass-throughs and K1s. Video number 9. What are the typical differences between taxable income and actual cash flow in a pass-through entity? Well, actually, these are the same as the differences between taxable and cash flow in any business, corporate, Schedule C, or Schedule F on a 1040. I've broken these items down into 6 categories, and if you learn the 6 categories, then you can handle almost any type of adjustment that comes your way. I call them the 6 N's, and the first 6 are necessary to get from taxable income to historical cash flow, what really happened in the checkbook. If you want to get the rest of the way to recurring cash flow, there are 3 more. So first, to get to historical cash flow, we can start with taxable income. But then we need to find and include in our expenses the non-deducted expenses, like the disallowed meals. Money they spent, but it's not been deducted, so taxable income doesn't reflect that expense yet. We also have to want to find and add non-taxed income. Income they received, but because it's non-taxed, it's not in the numbers yet. And then as we're going through, we want to spot in the tax return those non-cash items and back them out. Typically, this is where we get adding back non-cash depreciation, depletion, amortization. It's why we don't count net operating losses against them. That's a non-cash item, and there are others. Now those 3, non-deducted expenses, non-taxed income, and non-cash income and expenses, if we find and adjust for all of those, then we're getting close. We actually are to cash flow that actually occurred in the checkbook of the entity. But we don't lend on what did happen, we lend on what we think is going to happen. So if you're going to go on to recurring cash flow, one of the things you're looking for is new income or expenses. By definition, those weren't on the tax return, so we need the year-to-date financial statements or the application to look at closely. Then we look at non-recurring items. Now these are items that were in the tax return, they're in our numbers, but we don't expect them to continue. It may be an insurance or a legal settlement received, or it may be a non-recurring expense like flood repairs or something that's not typical for that business. The last N that I leave out of the numbers, I call it non-documented. This is most often on consumer or personal lending where they have additional cash flow, say from alimony received or capital gains, something that they don't need to qualify, so you're not going to bother to document. If you find all those 6 categories, then that will get you all the way from taxable income on the tax return to recurring cash flow available to pay debt for the business or available to pay out to the owners. If you enjoyed this information and you would like to receive all 20 free videos of the top questions lenders ask and should ask about business, personal, and global cash flow from pass-through entities, along with a copy of my tax return analysis quick reference guide, visit the URL on your screen.